Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing StarBucks stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 100 billion market cap. They're trading at $88 a share, and they have 1.1 billion shares outstanding. They were founded in 1971, 53 years ago, and they're the world's largest coffee house chain. They have over 35,000 stores in 80 countries. About 16,000 stores are in the US. They serve hot and cold drinks, whole bean coffee, and they have a ton of options: espresso, cafe latte, different teas, frappuccino, pastries, snacks. They also have seasonal offerings. And many stores offer free Wi-Fi internet access. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have lots of free cash flow. It was highest in 2021 at $4.5 billion, then nearly cut in half to $2.6 billion. But it is coming back. It's $4.4 billion in the trailing 12 months. Their latest financials are 12/31. Next week on April 30th, they're going to release their 3/31 financials. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty flat, around $4.2 billion a year. It was lower in 2022 at $3.3 billion. And their margins are in the low teens. They converted 12% of their revenue into net profit in the trailing 12 months. Revenue is the sales for the company, and that grows from $29 billion to $37 billion. Their revenue per share is $32.28. They pay a dividend yield of 2.6%, which means they have to pay out $2.6 billion in dividends for the year. And they have free cash flow of $4.4 billion, so they can cover their dividend payment. We estimated 4 years of future free cash flows. We also estimated the terminal value. It's all cash flows. Past year 4, that's $133 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $115 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of 101. They're trading at 88, so they're trading at a 13% discount. It's a buy according to the model. There are 60 companies in the same industry as StarBucks, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend the most in CapEx, $2.3 billion, because they don't franchise out all their stores like McDonald's, so they have to spend a little more on CapEx. But their stores are a lot less expensive to construct than a McDonald's. The cost to develop a StarBucks is under $1 million. It's usually between $500,000 and $1 million. To construct a McDonald's, it's usually between 1.5 and 2 million. We can't look at their debt to equity ratio. They have negative equity. They pay a good dividend, 2.6%, pretty close to the median, a little higher than McDonald's. They generate lots of free cash flow. McDonald's is number 1. They rank second in market cap, half of McDonald's. We can't look at their price to book, negative equity. They're trading at 23 times earnings, 23 times free cash flow, and about 3 times revenue. Decent ratios. They generate a lot of revenue, the most in this industry, $37 billion. But they have a different model than McDonald's. McDonald's makes most of their revenue on royalties from franchisees. They make a lot of their revenue on the sale of coffee and different products. It's a lot more revenue, just lower margins. Their 5-year annual revenue growth rate is 8%, higher than the median. They've done 6 stock splits, all a 2-for-1. The first is 1993, 31 years ago. Then 95, 99, 2001, 2005, and 2015. So it's been 9 years since a stock split. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $30,000 today. That's a 12% annual return. It's a pretty good return, a 200% total return. Let's look at their latest 10Q. Here's the 3 months ending 12/31/2023. Compared to the same period the prior year. Their fiscal year ends in September, so their 10K was in September. The fourth quarter of 2023 is this company's first quarter 2024 fiscal year. Revenue $9.4 billion, up from $8.7 billion. Most of the revenue is company-owned stores, $7.8 billion. They also license stores, $1.2 billion. So instead of franchising, they license. 60% of their revenue is beverages, $5.7 billion. Those are drinks within their company-owned stores, not the licensed stores. Food and company-owned stores, $1.8 billion, 19% of their revenue. $2 billion from royalties from the licensed stores. Also other things like pastries. They sell coffee beans. That's part of other. And other is 21% of their revenue, which is actually down from last year, 23%. It's also down in dollars. Very little though. Down only $2.7 million from last year. Here's a breakdown of their revenue by location. Of the $9.4 billion, $7.1 billion North America, $1.8 billion international, and they have $448 million of channel development. And this category is down. I'll tell you why. It was $478 million last year, now it's $448 million. And the reason it's down is because they sold their Seattle's Best coffee brand to Nestle. That sale was in the second quarter of 2023 for $19 million. Their operating income in North America, $1.5 billion, international, $240 million. Channel development, really profitable, high margins, $210 million. Let's go back to the income statement. They have to buy products. They spend $3 billion. They operate stores, payroll, electricity, rent, $3.9 billion. Total expenses, $8 billion. They report equity method investments, $56 million. These are their investments in other companies. Operating income, $1.5 billion, up from $1.25 billion. Net income, $1 billion, up from $850 million. EPS, 90 cents. They're buying back stock. Looks like they bought back 12 million shares. Let's take a look at the balance sheet. Current assets, $6.6 billion. Current liabilities, $9 billion. So they have a pretty weak current ratio. They may need to add some debt over the next 12 months. $3 billion of cash, $380 million of short-term investments. Accounts receivables, how much they sold on credit, $1.2 billion. They always have lots of inventory, $1.6 billion. Here's a breakdown of the inventory. $630 million unroasted coffee, $250 million roasted coffee. Other merchandise, $360 million. Packaging and supplies, $400 million. Their biggest asset is operating lease right-of-use assets. A right-of-use asset is an asset owned by another company that this company leases. There's probably lots of stores in this category. PP&E, $7.6 billion. A big chunk of their PP&E is leasehold improvements, $10 billion. Store equipment, $3.4 billion. Total PP&E is $18 billion. Depreciation, $10 billion. So the net amount is $7.6 billion. They have a lot of goodwill, $3.3 billion. This is from acquisitions. $500 million of their goodwill is North American companies. $2.8 billion international. Here's some of their bigger acquisitions. Teavana, they paid $620 million. That was back in 2012. Teavana was the fastest growing retail tea chain. Starbucks grew them to 379 locations, then shut them down. Instead, Starbucks sells loose leaf teas under the Teavana brand name. La Boulange, a bakery chain, they paid $100 million, also in 2012. When Starbucks acquired this company, they said they're going to grow it to 400 locations, but instead shut it down. Same thing with Teavana. They sell products under the La Boulange brand name in their own stores. They paid $30 million for Evolution Fresh in 2011, $72 million for Seattle Coffee in 2003, $8 million for Ethos Water. Let's go back to the balance sheet. Total assets, $29 billion, same as last year. Total liabilities, $38 billion, similar to last year. Their biggest liability is long-term debt, almost $14 billion. They have a lot of deferred revenue from all those gift cards. That's $6 billion. Also $2.2 billion in the current liability section. They raised $38 million from selling their business. They lost $8 billion from running their business. But the reason they have such a big retained deficit is because they buy back so much stock. If they didn't buy back all this stock, it would be a big positive. Let's take a look at a statement of cash flows. The first section is operating cash flow. That's how much cash the company generates from its operational business. $2.4 billion for the quarter, a lot higher than last year, $1.6 billion. Their net income wasn't that much higher than last year, only about $170 million higher. It just seems like in most of the categories they improved. There wasn't one big improvement. It was just a little bit in all the areas. They improved $40 million in depreciation. improved $60 million in distribution received. These are dividends received from the investments they own. They improved $15 million in non-cash lease costs. They improved $66 million in inventory. They sold $174 million of inventory. That's a net cash inflow. When you sell inventory, it's a cash inflow. When you buy inventory, it's a cash outflow. In the investing section, they spent $600 million of PP&E, property, plant, and equipment. This could be real estate or equipment for the stores. In their financing section, a cash inflow of $300 million from commercial paper. Commercial paper is short-term debt they added. They paid $750 million on long-term debt. They paid $648 million in dividends for the quarter. Last year, $608 million. They bought back a lot of stock, $1.3 billion. Last year, $190 million. I'll show you how stock buybacks detract from retained earnings. Let's go back to the balance sheet. They had a retained deficit of negative $8.1 billion. Let me show you how that's calculated. In the beginning of the quarter, they had a retained deficit of $7.3 billion. That was as of 10/1/2023. They were profitable, so that improves their retained deficit by $1 billion, but they bought back $1.2 billion of stock. That detracts from this number. They also paid out $640 million of dividends. That also detracts from this number. So retained earnings started at negative $7.3 billion, ended at negative $8.1 billion. If a company has a retained deficit because they're losing money, meaning their net income is negative, that's a problem. Because at some point you have to become profitable. But they are profitable pretty much every quarter. They just use that money to buy back stock and pay a dividend. So it's not that bad. Same thing with Boeing. They have a big retained deficit because they buy back so much stock. But if they need money, they can issue stock or just not buy back stock for that quarter. Let's look at SBUX on Simply Wall Street. Its last priced 88, 100 billion market cap, up 1% in the past week, down 23% in the past year. Let's see what they say about the company. SBUX operates as a roaster, marketer, and retailer of coffee worldwide. They operate through 3 segments: North America, International, and Channel Development. We saw that when we looked at the financials earlier. Its stores offer coffee and tea beverages, roasted whole beans and ground coffee, single-serve products, and ready-to-drink beverages, as well as various food products such as pastries, breakfast sandwiches, and lunch items. They also license its trademarks through licensed stores and grocery and food service accounts. They offer its products under the Starbucks Coffee, Teavana, Seattle's Best Coffee, Ethos, Starbucks Reserve, and Princey brands. They were founded in 1971, based in Seattle, Washington, where Nirvana is from. It looks like they started trading in the early 90s, and when you adjust for stock splits, it was well under $1 a share. Of course, it was never well under $1 a share. You can never buy the stock for $1 or less at any point. But when you adjust for stock splits, it appears that number. If you don't understand what that means, leave a comment and I'll explain further. It ran up to $18 in 2006, and then it came down below $5 in 2009. That would have been a great time to buy it. I wish I put all my money into this stock, because from 2009 to 2021, it grew like gangbusters. It peaked at 126. That was in August 2021. And then in mid-2022, it came down to $70, up again to 115 in May 2023, but it seems to be regressing the past 9 months. It's been trading between $80 and $100 the past 3 months. Simply Wall Street's valuation is 107. They also say it's undervalued. 29 analysts priced this stock at 103. Their revenue forecast for 2024 is $39 billion, 2025 $42 billion, 2026 $46 billion. Free cash flow forecast for 2024 is $4 billion, 2025 $4.7 billion, 2026 $6 billion. Do you think it's going to hit these targets? Their revenue has grown about 150% since 2013. It was $14 billion. Now it's up to $37 billion. COVID hurt this stock, but it more than rebounded since then. Now they're generating more revenue than ever. This red line is their debt. The blue line is their equity. I just did a video on Yum. It looks really similar. Debt looks really high, $15 billion. Equity looks really bad at negative $8 billion. But I showed you earlier, don't worry, they're just buying back a lot of stock. And they keep a healthy amount of cash on their balance sheet, $3.4 billion, plenty to pay the interest on the debt and a dividend. Their next dividend is to be paid on May 30th. The ex-dividend date is May 15th. X means without dividend. If you buy the stock on May 15th, you will not get the May 30th dividend because you'll be ex-dividend without dividend. You have to buy it before May 15th. It says it right here, buy in the next 18 days to receive the upcoming dividend. The record date is May 17th, so you have to buy the stock on May 14th or any time before. And you have to be holding it on May 17th. Because only the holders on record get paid the dividend. Say you bought the stock in 2023. If you sold it on May 16th, you would not get the dividend. If you sell it on May 18th, you got the dividend. Their dividend yield is between 1 and 3%. It peaked at 2.7% in 2018. The forecast is 3.1% by 2026. That's good news if you own this stock. The salary of the CEO is $1.3 million. Total compensation $15 million, tenure as CEO 1.1 years. He succeeded the great Howard Schultz. Loxman was an executive at Pepsi before this. In the past year, there's been one insider sell, no buys. 74% of the companies owned by institutions, 24% by the general public, and 2% by insiders. Their biggest shareholders, Vanguard, then BlackRock, State Street Geode, Howard Schultz, 1.9%. His valuation is $1.9 billion. He deserves every penny. He did a great job at growing and scaling this business. Morgan Stanley, 1.1%. Fisher, the Texas company, owns 1%. JP Morgan, 0.9%. RBC, Royal Bank of Canada, 0.8%. The Boston company, Loomis. The giant French company, Amundi. You know it's French. It says SAS after the name. Amundi is one of the largest European investment companies. Their employee count was 180,000 in 2013. Now it's 381,000. It was 402,000 in 2022. And the ticker trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Zitra, Santiago, Swiss, Lima Bolsa, Borsa Italiana, Wiener Börse, Kazakhstan, Santiago, Bulgaria, BATS Europe, Buenos Aires, Sao Paulo Bolsa, and NEO. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.